capital gains tax is actually one of my favorite taxes. I did a whole show on that, so you can go search for that. But it helps you save money. So capital gains is the difference of what you buy property for and what you sell it for. And it depends on the holding period. So the way that it's calculated, let's say you buy an investment like a stock. You buy a stock, you hold it for longer than a year. When you go to sell that stock, you will have a capital gain. Any appreciation that you've had between then is not taxed to you in a taxable account until you sell that property. Once you sell that stock, you then have a capital gain or a capital loss. You can have a loss as well if it's lost money. So if you've held that stock for longer than a year, then that could be taxed at 0, 15, or 20%. It depends on your other income. If you hold that for less than a year, then that's considered short-term capital gain or loss, and that is taxed at ordinary rates if it's a gain. Ordinary rates are things like your paycheck, pensions, etc. Those are by the tax bracket. So a capital gain that is long-term and held for longer than a year will be taxed at 0, 15, and 20, depending on the other income. So if you don't have any other income, you can have up to $44,000, I'm just rounding, of income single and $89,000 married filing jointly before you even have tax due on your capital gains property, which that's significant for $89,000. Conversely, I mentioned losses as well. So there is a netting process that happens each year. So you have capital gains and maybe you have capital losses. We do this a lot of times to try to be tax efficient, to try to harvest tax losses to offset capital gains. But maybe you just sell a property and it happens to be down. You net each year on your taxes for the realized, the ones that you have sold, capital gains and capital losses. You net them against each other, and then there's a netting process to that. And then whatever's left, you're taxed at. If you're based on your other income. So let's say you had $20,000 of capital gains for the year, but you had $30,000 of losses. You don't have any tax. You actually have a net $10,000 of loss. Okay, now that loss, you can use up to $3,000 of that $10,000 loss against your other income on your tax return. And then that $7,000 loss that you did not use because you're limited to the $3,000 will carry forward to future years. So next year, going into the tax year, you'll have $7,000. So it is very powerful to be tax efficient and be able to take losses. It's one of my favorite taxes because it's not taxed dollar for dollar. It's not ordinary income bracket. It has preferential treatment depending on your other income. Please feel free to reach out if you have any questions on your capital gains or your taxes. We'd love to talk to you.